If you're watching your portfolio bleed right now, you are definitely not alone. The charts are a sea of red, and that dream of a six-figure Bitcoin feels like it's drifting further away by the day. Just weeks after topping out near its all-time high, Bitcoin has been hammered, shedding over 21% of its value and crashing below key psychological levels. The price has fallen below the critical $100,000 mark, a level we haven't seen in months. Naturally, everyone is pointing fingers. You probably heard this is all because of a simple profit taking, or maybe you've seen headlines blaming some political drama, but that's not the real story. What we're actually seeing is a massive hidden wave of institutional selling, which then collide with billions in forced liquidations, all of it supercharged by a macroeconomic storm that almost nobody's paying attention to. This sell-off is a nasty combination of big money pulling out, macro uncertainty, and leverage traders getting absolutely wiped out. This isn't just a simple correction, it looks more like a structural shift in the market. In this video, I'm going to expose the scary truth behind what's really driving this crash. I'll break down the three invincible forces creating this perfect storm, show you the data that proves it, and explain what the big money is doing right now so you can understand what might come next. And this isn't fear-mongering, it's about understanding the brutal mechanics of the market. Because in crypto, what you don't know can absolutely wreck you. This is not financial advice and I'm not a financial advisor. So what's the mainstream narrative? Well, the easy explanation you'll hear on social media and in the news is that this is just a natural healthy correction. People will tell you that after the blistering rally that took Bitcoin to a new all-time high above $125,000 last month, investors are simply cashing in. They'll point to the classic crypto cycles where huge run-ups are always followed by steep pullbacks. Others might point to a specific event, like the political drama around the trade tariffs back in October that sparked volatility, or just general fatigue in the market. After the halving in April 2024, it's logical for miners to sell some of their rewards to cover their cost. And of course, investors who bought in at much lower prices are securing their gains. Some analysts also note that this kind of selling pressure often happens toward the end of the year as funds rebalance their portfolios. And look, these factors aren't wrong. They are part of the story. Profit taking is definitely happening, but to say that's the only reason for a drop this severe, one that wiped out over $1 trillion from the total crypto market cap, is dangerously simplistic. It completely misses the bigger, more powerful undercurrents that turned what should have been a mild dip into a brutal cascading sell-off. The real story isn't about a few people selling, it's about a fundamental change in where the big money is flowing, a devastating flush of leverage and a global economic environment that is actively hostile to risk assets like Bitcoin. To understand what's really happening, we need to follow the money. And the first stop on that trail leads us directly to the institutions that everyone was counting on to push Bitcoin's price to the moon. So for the better part of the year, the big story in crypto was all about institutional adoption. The launch of spot Bitcoin ETFs in the US was hailed as a game changer, and for a while it really was. These products opened the floodgates for a tsunami of institutional cash, which was a huge reason for Bitcoin's push to its all-time highs. The constant drumbeat of the institutions are coming finally became the institutions are here. But what happens when they decide to leave? That's exactly what we've been seeing over the past month. The river of institutional money hasn't just slowed down, it's just started flowing backwards. Over the last 3 weeks, digital asset investment products have seen staggering outflows totaling around $3.2 billion, and Bitcoin has been at the very center of this exodus. US-based spot Bitcoin ETFs, the very funds that symbolizes this new era of adoption, just posted one of their worst weeks on the record. This marked the third straight week of withdrawals, a clear signal that institutional demand is drying up at a critical time. This wasn't just a minor dip, this was a coordinated retreat. Funds managed by giants like BlackRock and Grayscale led the withdrawals, with BlackRock's IBIT fund seeing massive sums of exit in a single week. So why a sudden change of heart? It's not because these institutions suddenly lost faith in Bitcoin's long-term future, it's a cold, calculated response to a changing economic landscape. As one analyst put it, Bitcoin now trades like a macro asset, reacting to global liquidity and strength of the dollar and every whisper from the Federal Reserve. When these institutions see economic uncertainty on the horizon, or when safer assets like bonds start offering better returns, they de-risk. They pull capital from the most volatile positions, and for most traditional funds, that means Bitcoin. It's not personal, it's just portfolio management. They are moving to cash and bonds as the market hopes for a Federal Reserve rate cut have faded. The institutional money that was once a powerful tailwind has now become a brutal headwind, putting immense sustained selling pressure on the market. This isn't retail panic, this is a calculated professional reallocation of capital. And when billions of dollars head for the exit, the price is going to fall. But these outflows are only one part of this perfect storm. They created the initial downward pressure, but what turned it into a crash was the second deadly pillar, the great leverage wipeout. If institutional outflows were the sparked, then excessive leverage was the giant powder keg sitting right next to it. The crypto market, especially in derivatives, is famous for leverage. Traders borrowing money to use their bets. During the run-up to over $120,000, optimism was off the charts. Traders, both retail and professional, piled into leverage long positions, betting that price would only go up. This is where the danger lies. When you have a market that is overwhelmingly betting in one direction with borrowed money, it becomes incredibly fragile. It only takes a small push to start a devastating domino effect. That push came from the institutional selling we just talked about. As institutions began selling, the price of Bitcoin started to drift down, eventually breaking through the psychological $100,000 level. This initial dip, while not catastrophe on its own, was enough to trigger the first wave of margin calls. Traders with high leverage longs suddenly found their collateral wasn't enough to cover their loans. The exchange's risk engines then did what they are programmed to do. They automatically and forcefully liquidated these positions by selling the collateral. More Bitcoin on the open market. This is what's known as a liquidation cascade, and it's one of the most destructive forces in crypto. The first wave of forced selling pushed the price down further and faster. This in turn triggered the next larger wave of liquidations for traders who had set the liquidation points at lower levels. We saw this in dramatic fashion around November 3rd, when a staggering $1.1 billion in leveraged long positions were wiped out in just 24 hours. This process feeds on itself. Each wave of liquidation adds more sell pressure, which drives the price down further, triggering even more liquidations. It's a waterfall of selling that is entirely automated and merciless. It doesn't care about fundamentals or long-term stories. It's a mechanical process designed to flush out risk, and in doing so, it almost always overshoots to the downside. The market becomes a chaotic mess of forced sellers and terrified traders, and liquidity dries up because buyers are afraid of catching a falling knife. This leverage flush is a painful but a recurring feature of crypto. It's the market's brutal way of cleansing itself of excessive speculation. This latest event was particularly severe, amplifying the downward move far beyond what the initial institutional selling would have caused on its own. It turned a dip into a crash, but even this isn't the full picture. The reason both institutions and leveraged traders were on such a knife's edge is because of the third and perhaps most important pillar, the macroeconomic hurricane. For years, many in the crypto space wanted Bitcoin to be taken seriously on the world stage, to be treated as a legitimate macro asset. Well, congratulations are in order, because that's exactly what happened, but it's a double-edged sword. Being a macro asset means Bitcoin's fate is now tied to the global economy, interest rates, and the policies of central banks like the US Federal Reserve, and right now the macro environment is acting like a hurricane-force headwind. The single most important factor here is the outlook for interest rates. When interest rates are low, borrowing is cheap, and investors are pushed to seek higher returns in riskier assets like tech stocks and crypto. That's the risk-on environment that fueled much of the 2024 and 2025 rally. However, when central banks signal that rates will stay higher for longer to fight inflation, that's a dynamic flip on its head. Recently, stronger than expected economic data and tough talk from central bankers have crushed the market's hope for a near-term rate cut. When rates on safe haven assets like government bonds are high, investors have less reason to gamble on volatile assets like Bitcoin. Why take all the risk in crypto when you can get a decent, virtually risk-free return from a treasury bond? This caused a massive capital rotation out of risk-on assets and into risk-off assets. This is reflected in the strength of the US dollar. The DXY index, measuring the dollar against other currencies, has been rising. A strong dollar is typically bad for Bitcoin because Bitcoin is priced in dollars. A strong dollar means it takes fewer dollars to buy one Bitcoin, putting downward pressure on its price. So you have a situation where institutions are pulling back to de-risk, retail sentiment has flipped to extreme fear, speculative capital is also getting distracted with some interest shifting to other hot sectors like AI-linked assets. All of these factors, high interest rates, a strong dollar, and a fading risk appetite create a liquidity drain from the crypto market. When liquidity dries up, markets become fragile and prone to violent crashes where even small sell orders have a huge impact. This is the perfect storm. It wasn't just one thing, it was institutional de-risking creating the first wave of selling, which then triggered a catastrophic cascade of liquidations, all happening in inside a broader macro environment that is actively sucking money out of the system. Each factor amplified the others, creating a feedback loop that sent Bitcoin spiraling down. The market sentiment is sitting at extreme fear, and retail traders are understandably shaken. The narrative has shifted from euphoria to cautious pessimism. Analysts have noticed that the current conditions with weak ETF flows and a soaring macro sentiment feel a bit like the early stage of a mini bear market. The key thing to watch now is whether institutional buyers step back in to defend these levels. Those heavy ETF outflows need to slow down and eventually reverse for the market to find a stable floor. However, it's also important to hear the other side. Some experienced investors see this brutal correction as necessary. Even a healthy cleansing volatility like this shakes out the overleveraged speculators, and we can't, transferring assets to investors with long-term conviction. One financial advisor even noted that every major correction in Bitcoin's history has paved the way for a substantial gain for patient investors, framing this as a time that demands perspective, not panic. Some analysts argue this is just a cyclical reset within a larger institutional adoption phase, not the start of another multi-year crypto winter. They point out that despite the recent outflows, the amount of institutional capital in the ecosystem is still vastly greater than in previous cycles. The future will likely depend heavily on the Federal Reserve's next move. Any hint of a pivot back towards lower interest rates could reignite risk appetite and send capital flooding back into crypto. On the flip side, continued hawkishness will likely keep the pressure on. This is not time for emotional decision, it's time for careful observation. Watch the ETF flows. The easy mode of the bull run is over. We are now in a far more complex market, one being dictated by massive invincible forces. Thank you guys for watching, don't forget to like and subscribe, and I'll see you guys in the next video.